Welcome back to Primary Source China Investment. Peng.guo and I are here with show V2, and we're going to cover an asset class that we've talked about a lot, and it just seems that nobody wants to listen to us, and that's China fixed income. And we're going to get into some interest rate discussion, we're going to get into some specific names, and we're going to get into some of the size and comparison with FX and the US market. So first up, you recall a few months ago, Evergrande and other property developers were firmly in the spotlight for missing bank payments or leaving condo developments unfinished. Anyone with a Twitter handle or a tangential link to China expressed an opinions, and that was really a barbell. It was either Evergrande is going to be China's Lehman moment, or it's going to be a real, like a nothing burger. It's going to be settled. And, Peng.guo and I talked about this. And Peng.guo, remember, I remember what you said, that it will be contained. Evergrande will be contained. And right now, we're seeing that, right? Evergrande's basically contained. They're going to be a workout, right?
That's exactly right. So this is the first thing the government to do it. But unfortunately, this is not just the Evergrande one company's problem. So it's really for the entire real estate business, as well as the business model structure problem for the China economy. It's very hard to solve it, but unfortunately, it's in the bad timing. I think the government, the first thing is really try to help the financial institution to get affected by this big event.
So that's exactly right. So the financial institutions are going to have to line up behind that. And this is a subtle difference in China bankruptcy. So there's two ways to work through bankruptcy. One is called worked out, and the other is bailed out. So what's happening now with these property developers is they're being worked out versus what happened with, you can all Google Huarong, which is bailed out, which is when a government entity fails, the government steps in. So this is important to remember because when you're looking at China fixed income, you need to do your credit analysis. But before we get to that, I wanted to talk a little bit about the debt to GDP ratio. And there's a lot of discussion about how much debt China has, how much is public, how much is private, how much is on balance sheet, how much is off balance sheet. None of that matters. The point we're making here today is the directionality. Total debt to GDP is rising. So we're going to put a chart up and you're going to see that rise for the last decade or so. And it's important to remember that debt does matter. Eventually, it does matter. So the next piece is interest rates. On the US side, we've seen the 10-year go from 1.4 to 2 in 6 weeks. And that sent the price of the big ETFs down significantly as well. I guess IEF and AGG both went down about 4.5% in that time period. And that basically wipes out 2 years of coupon payments. So contrast that to my favorite China fixed income ETF, which is CBON. And it turns out that's up 1% year to date, and it has a yield of 2.28%. The comparison is not precise here, as the individual bonds in CBON are all state-sponsored firms which carry the implicit sovereign rating. Think of big banks, China Development Bank, think of government-sponsored entities in the power sector and the heavy industry sector. And remember, China's sovereign rating is A+ from S&P, while the US is 3 notches above that at AA+. And remember, we'll put up the top 10 holdings of CBON. They're all state-run enterprises.
I think you mentioned a very key point. So right now, all the asset class is really based on the interest rate. So that is much powerful than any other factors. So in the past 3 months, the whole world is under the federal raising interest rate expectations, and the price and the market price in bond, stock, or the asset class. But in China, like I said in the last time, China may have the different cycle. So their interest rate rising and downtrend could be different from the United States.
Yeah,
so
actually, China 10-year is actually down over the last 3 months.
That's true. So that's if you see that this China Treasury bond, 5 years and 10 years, so it's the price is still up, the market interest is still down. especially in the January, and it looks like China Central Bank probably released almost like the 6 trillions into the economy. MQ increased almost 10%. But from majority of the increase, it really came from the enterprise. So enterprise probably take almost 85%. So most and as a result, in the stock market, you can see infrastructure related sectors get boomed. Is pretty clear.
Yeah, those are the stocks. That's where the liquidity goes to when they release this liquidity.
Yeah, China economy still rely on the export infrastructure or investment from the government, as well as the individual consumptions. So export is pretty good, and the international trade soared in the last year. But everybody knows while everything back to normal, it is definitely will be done. So nobody expect too much in that area. And individual consumptions really get hurt. I think from the China Spring Festivals, so if you can see the like the wine consumption or the movie ticket trend, so you will know like the individuals don't really have too much disposable income to consume for those basic things. So you cannot nothing to reach that. So as a result, I think the government and back to the old way. They put a huge investment into the infrastructure again. I think right now it's like the maybe infrastructure 2.0 or 3.0. They really increase.
No, at this point, China infrastructure is on like year 15.0. You know, this is.
Yeah, I think it's still the bad way. It's still back to the old way to inspire the economy. So they use this way for many years, but obviously everyone knows that this caused a huge problem with that. I don't think they have effective solutions right now, but they have to use this way to keep the economy.
And remember, if you're a government official, that's how you raise your revenue, through real estate sales, and that's hard to get off of that. Hard to replace that when it's such a massive piece of the economy. So the last thing we wanted to touch on here is the FX rate, because remember, if you're a US investor and you buy CBON, you're buying in US dollars, and the manager is taking those US dollars, converting to renminbi, and buying renminbi denominated fixed income. So what's happened with the renminbi over the last few years? There's definitely been some two-way volatility. But overall, the renminbi has appreciated about 7% over the last 5 years relative to US dollar. That's a strong tailwind in a fixed income market that is only giving 2.5% yield.
I think definitely, if you see the chart, we can see that renminbi is in the appreciation for a very long time. I think generally speaking, most of the countries like the depreciation of their currency, so they can increase the export. Right. But I think right now it's really to control the United States really facing a historical high inflation. Increase the currency value could reduce and control the inflation. So I think many countries realize that this kind of the things. So they started to love the appreciation of their currency. So you will see they say nothing about it. So I think right now, China renminbi the uptrend is probably get stopped. You will see it right in the past couple of months. It's pretty get flat. So that maybe means the depreciation or like the short-term volatilities could be coming to the market.
Yeah, we've seen periods of that over the last decade or so with renminbi US dollar. But remember, currency is global. Even though China does have a lot of gates in terms of moving money around, there's a lot of places that will trade currency very freely. So China doesn't operate in a vacuum, neither does US dollar. So interest rates are global.
That's exactly right.
Yeah. So we're going to leave it there for show V2. Thanks so much for tuning in. Peng.guo and I really appreciate all of your support for going on a year now. So please hit the subscribe button if you haven't already, and tune in next week. Thank you.
Thank you.